They are scrambling. U.S. Gov spends 7.4 B to secure silver before it's gone. For decades, silver lived in the background of the global economy. Rarely discussed, rarely defended, rarely feared. And then, quietly, without warning, the United States government committed $7.4 billion to secure it. Not through speeches, not through emergency laws, but through a move that only happens when time is running out, because governments do not rush into commodities unless something fundamental has changed. They do not spend billions unless the risk of waiting has become unacceptable. And they certainly do not act in silence unless the consequences of public attention would be worse than the problem itself. This was not about inflation headlines, not about green energy slogans. This was about a material the modern world cannot function without, and a moment when those in power realized they might lose access to it. If silver were abundant, this deal would not exist. If supply were secure, there would be no urgency. And if the danger were theoretical, the Pentagon would not be involved. What you're about to hear is not opinion. It is a sequence of decisions. Decisions that only appear after the warning signs and before the consequences become visible. Because when governments scramble, they do it quietly, and they do it early. And by the time the market understands why, the window is already closed. Welcome to Hidden Currency. If you have lived long enough to see systems change, to watch policies reverse, to witness what once felt permanent quietly disappear, then this channel is built for you. Here, nothing is rushed, nothing is exaggerated, and nothing is said without purpose. If you believe understanding comes before action, and preparation matters more than reaction, then consider subscribing, not for trends, but for clarity. And before we go further, tell us something important. From where in the world are you watching today? For most of modern history, governments have followed a familiar pattern during economic stress. First, they deny the problem. Then, they downplay it. Finally, when delay becomes dangerous, they act quietly and decisively. The decision to spend $7.4 billion to secure silver belongs firmly in the final category. This was not a public announcement designed to calm markets. There was no national address, no widely broadcast debate, and no clear explanation offered to the public. Instead, the decision appeared buried inside technical language tied to industrial capacity and defense planning. That silence was the first signal that this move carried far more weight than it seemed. Silver has always occupied a strange position in the economy. It is not treated like oil, which dominates headlines, or like gold, which carries symbolic meaning. Yet, silver exists inside nearly every critical system that modern society relies on. Power grids, communications networks, medical equipment, satellites, and military hardware all depend on silver's physical properties. There is no substitute that performs the same role at scale. For years, this dependency felt manageable because global supply chains appeared stable. Metals were mined in one region, processed in another, and shipped wherever demand existed. That system worked only as long as trade remained smooth and politics stayed out of the way. That assumption is now breaking down. What changed was not a single crisis, but a steady buildup of pressure. Industrial demand continued to rise while mining output failed to keep pace. Silver production remained limited because it is usually mined as a byproduct, not as a primary resource. Even when prices rose, supply could not respond quickly. This structural weakness remained hidden until global tensions exposed it. By late 2025, policymakers were forced to confront an uncomfortable reality. Silver was no longer just a commodity. It had become a strategic vulnerability. Governments do not enter supply chains unless private markets can no longer guarantee access. When they do, it signals that price alone is no longer trusted to solve the problem in time. Security replaces efficiency. Control replaces convenience. The size of the investment revealed urgency. This was not a test project or a small grant. It was a full commitment. That suggests the decision was not experimental. It was reactive. For businesses, this moment carries an important lesson. Governments reveal their true concerns not through statements, but through spending. When official messaging suggests calm but capital moves aggressively, capital is telling the real story. Many assume governments act slowly. In reality, they act slowly until they decide they cannot afford to wait. When that moment arrives, years of planning compress into months of execution. This was one of those moments. The silver market did not suddenly become important. It was always essential. What changed was recognition. And once recognition reaches the highest levels, markets tend to follow, often later than expected and never gently. This is not a prediction. It is a pattern. When governments scramble, they do so after deciding that inaction is the greater danger. That decision has already been made. To understand why silver triggered such an aggressive response, one must first understand how quietly essential it has become. Unlike oil or semiconductors, silver rarely appears in strategic briefings meant for the public. Its role is hidden inside systems rather than displayed at the surface. That invisibility is precisely why the risk went unnoticed for so long. Silver is not consumed for status or speculation. It is consumed for function. It conducts electricity better than any other metal. It resists corrosion. It performs reliably under extreme conditions. These properties are not optional features. They are requirements in advanced technology. Remove silver and entire systems fail, not gradually, but immediately. Over the past 2 decades, demand for these systems increased faster than policymakers expected. Renewable energy infrastructure expanded. Data centers multiplied. Defense systems became more electronic and less mechanical. Medical devices became smaller and more precise. Each of these trends pulled silver from the same finite supply pool. At the same time, the supply side grew fragile. Silver is rarely mined on its own. It is usually a byproduct of mining other metals. That means production does not respond quickly to higher prices. Even if demand surges, output cannot easily increase. This structural rigidity is critical. It turns normal demand growth into long-term shortages. For years, this imbalance was masked by global trade. But trade efficiency depends on trust and stability. Once those disappear, the system loses flexibility. That is when stockpiles matter more than contracts. By the mid-2020s, several warning signs appeared simultaneously. Processing capacity was concentrated in fewer countries. Export controls became more common. Industrial demand forecasts consistently underestimated real usage. Military planners noticed that components once considered cheap and abundant were becoming harder to source on schedule. At that point, silver crossed an invisible line. It stopped being treated as a commodity and started being treated as infrastructure. Infrastructure cannot be allowed to fail. The private sector felt this pressure first. Manufacturers began locking in long-term supply agreements. Premiums appeared between physical delivery and paper prices. Delivery timelines lengthened. These are not speculative signals. They are operational ones. They appear when supply chains strain under real-world constraints. Governments observe these signals quietly. They do not react to headlines. They react to delays, shortages, and risk assessments. When multiple industries report the same friction point, it triggers strategic review. Silver passed through that review and did not emerge as optional. For decision makers, the problem was not price volatility, it was dependency. Relying on foreign processing meant relying on political alignment that could change overnight. In such a scenario, even friendly nations prioritize their own needs first. History provides countless examples of this behavior. When markets function smoothly, governments remain in the background. Prices guide behavior, contracts manage risk, and private capital allocates resources. But when markets begin to fail at delivering certainty, governments do something different. They stop observing and start positioning. Part 3 of this story begins at that exact transition point. The most revealing aspect of the silver decision was not the money involved. It was the structure of control. This was not a simple purchase agreement or a temporary supply contract. It was a move upstream into ownership and infrastructure. That choice signals a loss of faith in markets as reliable allocators under stress. In economic history, this pattern appears only during periods of systemic transition. When states fear disruption, they do not compete in open markets. They remove assets from those markets entirely. Control becomes more valuable than price efficiency. Access becomes more valuable than profitability. This is where many observers misunderstand what is happening. They assume the decision was defensive. In reality, it was strategic. By securing processing capacity, decision makers ensured priority access regardless of future conditions. That matters far more than locking in a favorable price today. Silver processing is not easily duplicated. It requires capital, environmental approvals, skilled labor, and time. Years, not months. That time constraint changes behavior. When future scarcity is anticipated, early movers gain lasting advantage. Late movers face dependence. This logic applies equally to corporations and states. The difference is scale. Governments can absorb inefficiency in exchange for certainty. Private firms cannot. That is why state action often marks the point where markets are no longer trusted to self-correct fast enough. For entrepreneurs, this shift should feel familiar. It mirrors what happens when a company vertically integrates. When suppliers become unreliable, firms bring production in-house. Not to increase margins, but to reduce risk. Governments apply the same logic, only with national security consequences. Another subtle detail matters here. This move occurred before a visible crisis. There were no widespread shortages reported to the public, no official rationing, no declared emergency. That timing is critical. Strategic actors move before pressure becomes obvious. They act when outcomes are still avoidable for themselves, not when they are forced. This creates a gap between perception and reality. The public sees stability, insiders see narrowing options. That gap is where the most consequential decisions are made. Control over silver is also control over downstream industries. Electronics, defense manufacturing, renewable energy, and advanced medical systems all depend on predictable supply. When governments secure the upstream node, they indirectly influence everything below it. That influence does not need to be exercised publicly. Its existence alone changes behavior. Businesses begin to adapt quietly. Suppliers reprice risk, contracts shorten. Inventory strategies shift from efficiency to resilience. None of this makes headlines, but all of it affects margins and competitiveness. The shift from market reliance to infrastructure control also signals something deeper. It reflects a change in how risk is perceived. For decades, economic planning assumed globalization would continue. Disruptions were treated as temporary. This decision suggests that assumption has been revised. When planning horizons shorten, control becomes a hedge against uncertainty. Ownership becomes insurance. That is the logic behind the move. There is also a psychological dimension. Once governments act, others infer information. They may not know the details, but they know enough to adjust. Capital begins to reposition. Strategic metals attract attention. Supply chains are reassessed. This is how structural change propagates without announcements. For young entrepreneurs, the lesson is not to imitate the scale, but to study the behavior. Watch where control is being consolidated. Watch which bottlenecks are being secured. Those areas reveal where future constraints are expected. Markets reward those who anticipate constraints, not those who react to price changes after the fact. By the time prices fully reflect scarcity, strategic positions are already taken. Part 3 establishes the turning point. This was not about responding to a shortage. It was about preventing dependency in a future that now looks less stable than before. The final part will address the most uncomfortable implication of all: what happens to markets, prices, and private actors once strategic control quietly replaces open access, and why the consequences arrive unevenly and without warning. The final phase of this story is the one most people notice last, not because it is hidden, but because its effects arrive unevenly. When strategic control replaces open market access, the consequences do not appear all at once. They emerge in layers, affecting different participants at different times. The first group to feel the change is not investors. It is operators. Manufacturers begin to encounter longer lead times. Procurement teams notice suppliers becoming selective. Contracts that once guaranteed delivery now include exceptions and force majeure language. These are early signs that availability is being rationed quietly without public acknowledgement. Markets, meanwhile, continue to display normal behavior. Prices move within expected ranges. Volatility appears manageable. To casual observers, nothing seems broken. This disconnect is dangerous. It creates the illusion that strategic actions have no immediate effect. In reality, they are reshaping incentives behind the scenes. When governments secure upstream control, they reduce the amount of material that reaches the open market. Not dramatically at first, just enough to tighten flexibility. This reduction does not need to be large to matter. In tightly balanced systems, marginal changes have outsized effects. As access becomes less certain, private actors adapt. Larger firms with leverage secure preferential agreements. Smaller firms absorb higher costs or accept delays. This is how strategic control amplifies inequality within markets. It favors scale, relationships, and political proximity over efficiency. Over time, this behavior feeds back into pricing. Spot markets become less relevant. Long-term agreements dominate. Price signals lose clarity because fewer transactions occur in transparent venues. The market still exists, but it becomes thinner and more fragmented. For investors, this creates confusion. Traditional indicators fail to explain outcomes. Prices may remain subdued even as shortages intensify. This is not manipulation in the traditional sense. It is the result of material being redirected before it ever reaches price discovery mechanisms. Entrepreneurs who rely solely on market data find themselves reacting late. Those who study supply chains, ownership structures, and policy incentives see the shift earlier. This difference in perspective determines who adapts and who struggles. Another important consequence follows. Once governments commit to control, reversal becomes unlikely. Infrastructure investments are long-term by design. They lock in strategic priorities for decades. Even if conditions improve, the incentive to maintain control remains. No authority willingly returns to vulnerability. This permanence matters. It means the change is not cyclical, it is structural. Markets may fluctuate, but the underlying access rules have changed. That reality reshapes long-term planning across industries. The final implication is psychological. Confidence in markets depends on trust. When participants suspect that access is uneven or that rules can change without notice, behavior shifts. Inventory hoarding increases. Redundancy replaces efficiency. Costs rise system-wide. These outcomes are not failures of capitalism. They are responses to uncertainty. When certainty disappears, resilience becomes the priority. That transition always carries a price. For the business community, this moment demands a different mindset. The question is no longer where prices will go next quarter. The question is, who will have access when conditions tighten further? Access, not valuation, becomes the critical variable. Young entrepreneurs often assume opportunity emerges from disruption. That is only partially true. Opportunity favors those who understand the direction of control. Aligning with emerging structures matters more than betting against them. This does not mean pessimism, it means realism. Strategic shifts do not signal collapse. They signal reordering. Those who adapt early often thrive. Those who cling to outdated assumptions struggle longer than expected. The silver story is not about one metal. It is about how modern economies behave under pressure. When complexity increases and trust declines, control consolidates. That pattern repeats across history. The warning embedded in this story is quiet but clear. Markets are changing not because of headlines, but because of decisions made far from public view. By the time effects become obvious, strategic positions are already occupied. Those who wish to navigate the next decade successfully must learn to read actions, not narratives. Capital allocation reveals intent. Infrastructure reveals fear. Control reveals expectation. And once expectation shifts, the future follows, whether the market is ready or not.